So how do you avoid misunderstandings between the liquidator and the director? Well, particularly in relation to something like an overdrawn director's loan account. Well, the answer is need to understand the position of each party, and in particular the director needs to understand that the liquidator enters their office as a stranger. It cannot be assumed that the liquidator can just understand all the ins and outs. The liquidator wasn't there. The directors will have run the company for years or whatever, a period of time, and they will know what they did and why they did it, or they should do, certainly, if they're running the company. Whereas the liquidator wasn't there. So transactions that the directors entered into, the liquidator can only, if the records are insufficient, the liquidator can only speculate or ask the director about the transactions and so on. Now, this comes on to the next point, which is that where a director has received money from a company, and this may lead to things like, for example, an overdrawn director's loan account, which the liquidator has a duty to deal with as an asset of the company, to recover it from the director, except when it's disputed or cannot be recovered for any reason, then that's a separate matter. But the basic principle obviously is if an asset of the company, the liquidator has to recover it. Now, where misunderstandings can arise is how the liquidator is to embark upon resolution and understanding the company's transactions. So what the director has to do is try to understand. The liquidator will understand the position of the director. It's very commonplace, for example, for a director to turn around to a liquidator and say, "Oh, I'm not an accountant." Absolutely, there's no issue with that. But remember what an accountant is. An accountant is somebody that doesn't usually enter into the transactions. They account, they allocate, and they post transactions based on client instructions, assemble the accounts, put them together so that the director and the company can comply with company legislation, tax legislation, and so on. That's ultimately, and obviously there may be tax planning and so on and so forth, but ultimately the key underpinnings of transactions should come from director instructions. The director should know why they entered into a transaction, and in particular, when the director has received money from a company, the director should know why, whether it's dividends, salary, loans, repayment of expenses, whatever, they should know. It shouldn't be a situation where a director receives money from a company and doesn't know why they've received that money. It's bordering on something which is untenable. It's inconceivable that a director would receive money from a company personally and not know why they've received it. They should know what the reason is. Now, this comes on to the case of when there is a query by the liquidator as to the receipt of money from a company, so the liquidator can reconcile the monies in and out of the company's bank account to and from the director and through the director's loan account if the director has incurred expenses on behalf of the company that don't flow through the company's bank account. So the liquidator needs to do two things, which he or she will need the director's assistance on. One is to establish the facts as to the nature of the transaction. Was it salary? Was it dividends? Was it loans? Was it repayment of expenses? And so on. The other then is once the directors asserted what the transaction was, the next point of call is to say, well, what's the evidence for the transaction? Where's the declaration of the dividend? Where's the real-time information to HMRC in relation to salary? Where's the receipts in respect of expenses incurred on behalf of the company personally through the director's personal bank account, for instance, etc. Now, ultimately, that will then enable resolution and avoid these misunderstandings. The worst thing that can happen sometimes is where the liquidator turns around to the director and says, right, okay, we think you're overdrawn. And the director says, no, I don't think I am. And then basically there's this adversarial type problem, and sometimes the director doesn't know what to do to resolve, and sometimes the liquidator can't progress it because the director doesn't know what to do. So you end up with a sort of catch-22 no man's land type situation where and what you want to do is get to a position where each party understands what the role of the other is, so that they can then move forward and resolve the matter consensually. Questions, queries, concerns, give us a shout. We know insolvency inside out.